how do we find a property? And they went out and bought a house and they renovated it and they drafted the documents together. They studied the purchase and sale agreement. They studied the whole thing. And in 18 months, they sold the property and they all made a profit. So you couldn't get in the class if you hadn't invested $10,000. I thought that was wonderful.
Yeah. Welcome to Real Estate Hustlers Podcast. I am your host, Josh Appleman, founder and CEO of Appleman Properties. Today we're joined with Mr. Gene Trowbridge. Gene is a veteran in real estate and law since 1972, excels in syndication and legal guidance. As a CCIM Senior Emeritus Instructor and award winner, he has founded the Trowbridge Law Group, specializing in real estate syndication with over $5 billion in offerings. Gene, we appreciate you coming on the show today. If you could let the listeners know a little bit more about yourself.
Well, thanks, Josh. This is a real thrill, pleasure. So I came out of college and I went right into the business of selling commercial real estate. And then somewhere along the line, I started buying some properties for myself. And just like every other syndicator I know, I found a property that I couldn't buy by myself. So I had to reach out to friends, really people I'd gone to college with. And we amassed enough money to buy the property. There were 5 investors. I didn't even know what the word syndication meant. I just went ahead and did it. One of our partners was an attorney, so he drafted the documents, but I did the real estate part, and that was just fine. And so that went on, and eventually, I decided that I was just going to drop being a broker and concentrate solely on being a syndicator. So I was a syndicator for about 20 years. The biggest part of my career in syndicating, Josh, was to build self-storage facilities in Southern California. And we did 16 offerings, and each offering had two self-storage facilities in it. And that was going along very well. And then somewhere along the line, 1994, 95, I had it. I'd had it as being a syndicator. I had sent out, I think it was 1,676 K1s one year.
Oh, wow.
And in those days, guys, there were no syndication pros. There were no, we had to do all that stuff.
Manually.
Lick the envelopes and put stamps on it and all that stuff. And I said, this is not going to go any bigger than this. So I went to law school and graduated from law school and saw the peaceful demise of my syndication practice and started being a syndication lawyer. And now I've been doing that for just about 30 years. And that's all I do. It isn't all real estate. Actually, last year we helped someone buy a professional hockey team, a minor league hockey team in Texas, and fiber optics cable company, and some lending platforms where they lend money to merchants on a daily basis and get it back. But there are a lot of things, Josh. Just as a thought, the SEC every year prints a experience booklet, and in December, the experience booklet came out for 2023, and the market for private placements, which is what we do, $2.7 trillion in the last year. It's a huge market.
Wow.
And it isn't all real estate. Maybe a quarter of it is real estate. But every business, a small business that doesn't want to go to Wall Street and raise their money, uses the private placement world, which as Regulation B. That's where all this money is raised. So it's a big business.
Gene, were you the operator as well when you were doing the syndications?
Everything. Yes, I was. And one of the things that was interesting and helped me make a decision to make a change, is for many years I raised all my money through the broker-dealer network. I used registered agents to do it. And that was a lucky thing that I got into that. That was my marketing department, and that was great. But 94, 95, REITs started coming out. And in a real estate investment trust, there's liquidity. And in those days, we were using limited partnerships, and there's no liquidity. So the broker dealer community started going toward the liquidity product rather than the limited partnership product. And you're pretty young, but you might remember 94 was a crash in the real estate business, just like 2008 was. So money raising pretty much ground to a halt. So I thought I had quite a bit of equity, quite a few projects that were going to last 6-7 years, and so I just changed my attention and went to law school.
You mentioned liquidity, kind of when REITs joined the picture. Is that kind of? I know you're familiar with blockchain and tokenizing properties, and that's supposed to be kind of or familiar, not know, but that's supposed to generate liquidity, or
Sure.
You're able to trade your shares in pieces of real estate, and it's supposed to act like a currency as well.
Well, I don't deal with any of that. I've stayed away from that. Maybe that's wrong, but I've stayed away. But there's one big company that I know of pretty well out of the Salt Lake City area that's trying to make a secondary market for interests in LLCs and limited partnerships. And I've been there and visited their office, and that's kind of interesting. I can probably think back at 3 or 4 times in my, gosh, it's almost a 50-year career now, where people have tried to provide liquidity. It hasn't really happened, but this one just might work. I'm not sure. I'm watching it.
So are they offering to buy people's shares as a limited partnership and offer them a buyout? Is that kind of their model? Okay.
I would put in the operating agreement that that allows this one company to buy, and then once they get it, hopefully they have investors who would like to buy. It's kind of tricky because you can't sell someone else's security unless you're a securities broker. So I'm thinking what they're going to be doing is matching. They might have a stable of investors who would like to buy something, and if you wanted to sell, you can sell your own security. So maybe they'll match you up and do that. So that's kind of new. Really, this year, just getting started. I get a lot of marketing. So anyhow, I do this business, represent a lot of clients and a lot of beginning clients who are doing their first deal. And I guess my most prolific client has done 164 offerings with me since 2014, and that's pretty, keeps me busy.
Well, it's and I guess for the audience, if you could just tell us what a syndication is, and I guess what it entails, and what the do's and the don'ts, high level.
Sure. I get a lot of what I call, Josh, homework calls, where people will call me and say, "Hey, Gene, I've been referred to you, and I want to put together a deal with 10, 15 investors, and I don't want it to be a syndication." And I say, well, that's really the wrong question, because a syndication is any time there are 2 or more people involved in a business transaction together. You can have a syndication with just me and you. You know, I can have a syndication. Tesla is a syndication. Okay, so it can be very small, it can be very large. The question really is it a security? And the federal government, way back in the early 1930s, found after the stock market crash that investors and the general public needed the protection of the federal government so that they weren't buying crazy things and making bad investments that led up to the stock market crash. So they formed the Securities and Exchange Commission, and then the Securities and Exchange Commission decided to license people to sell securities. So the first thing they needed to know or needed to have was a definition of a security. And so that's why the question is, I don't want this to be a syndication, Gene, isn't the right question, because we already know that if you put people together, it is a syndication. But is it a security? And in layman's language, a security is when investors put their money into an investment vehicle like an LLC or a limited partnership, and they expect a profit. But there's going to be someone else running it. The investors are passive. In the LLC world, the manager is active, running the project. And so that's where you fall into the world of securities law, because the government is interested in regulating what you're selling, the paperwork, and regulating who's selling it. So there are really two laws that we work with. And what I do is I work primarily with the first law that is designed to make sure the investors have full disclosure so they can make an informed decision after they get all the material facts. And so that's when you write the documents, the operating agreement, the private placement memorandum, the PPM, the subscription agreement. That's what we do. That's the first law you have to comply with. The second law is to protect investors from crooked people who are selling securities. So that law says unless you're selling your own security, you have to be licensed. So it's like real estate, Josh. It's like for sale by owner. If I put together an LLC and I want to sell shares in my LLC, I can do that without a license. But you couldn't. You couldn't sell interests in my LLC unless you were licensed. So in the securities world, it's called the issuer exemption from having to be licensed, as opposed they could have called it for sale by owner because it's exactly the same thing, but that's the analogy. So here we have the people on the homework call say, what about a syndication? Well, it is a syndication. Well, what about being a security? And that really boils down to if there's that active person making it happen. If 4 or 5 people get together and form an LLC and buy a property and they all make the decisions, everything that's voted on has to be unanimous and every person has exactly the same vote, regardless of how much money they put in. That's not a security. That would be technically a member managed syndication. And if there's no manager, I'm not talking about property manager, I'm talking about manager of the LLC, it's not a security. So that's the first thing I have to do. I'd have to say to you, Josh, if you were calling me, are you going to make the decisions? Are you going to get paid? And most of the people say, yes, I'm going to make the decisions, and yes, I'm going to get paid. And I say, well, there you go. You now have a security because you're the manager, and that fits right in the definition.
Yeah, and I think that it comes with a extraordinary amount of responsibility creating a security and creating a syndication. Even if you're putting third-party property management in front of you in real estate, for instance, you're still the jockey on a horse. You're still responsible to send out the K1s, like you had mentioned earlier. You're still responsible for the overall performance of the deal to make sure that it is going within the business plan, to make sure that there's investor communications, to make sure that you're able to answer questions as they come up. So I think that there needs to be a certain amount of business acumen before exploring a syndication or partnering up with somebody who has that attribute. But it is definitely a viable way to scale and grow, utilizing other people's money as well as other people being able to place their capital into your offering and them feeling like it's a safe, secure way of making their money grow in an instance.
I think you're right. In 2022, I did 37 interviews with my clients. And I asked them, just like we're doing here, I asked them each person the same 3 questions. How did you get started? What do you think is going to happen the next 3 years? And what advice do you have for rookies? Everyone said they got started, just like I said. They found a property they couldn't buy by themselves. And one of the pieces of advice I have for people, I have people call me and they say, I'm in 20 deals as a passive. Now I want to be the syndicator.
Yeah.
And I say, why?
Yeah.
Aren't you getting rich from being a passive with no risk? Why would you want to do this? But some people do, and as I did. And so we went on to start our deal. And then the last question was, what advice do you have for rookies? And everyone dances around it, but it's the same answer. This isn't a do-it-yourself business.
No.
First of all, Josh, if you came to me with an offering and it was a good property and I thought it was great and you needed $50,000 from each investor, I might say to you, Josh, I'm happy to invest, but Josh, tell me, if I give you my money, what happens if something happens to you?
Yeah.
And
What is the plan?
that's usually a showstopper. So our firm's policy is we won't deal with a client where the manager is an individual, one individual. It's too risky during COVID. I'm aware of, not in our company because we don't do that, but I'm aware of people who died who were managers of an investment. And now all the limited partners or the members are just, they're out on their own. They don't want to be the manager. They don't know. And there was only one person who had the authority to sign documents who just died. And people get divorced and they get sued. And I had one of our clients hit his head on a rock skiing in Park City many years ago and came out of that as a quadriplegic. Luckily, he had a partner in the business to pick up. So it's not a do-it-yourself business. And that's really the truth.
And death is a real thing, and it's funny that you had mentioned that because we do use the death metaphor around here. What if I die? Then what? It's an if then this happens, because you have to think, what is the protocol there if something does happen? Payroll still needs to carry on, projects still need to continue, and people ultimately are not only relying on you, but they're relying on the company to feed for their family and carry on. So there needs to be the process, but a standard scope of work for really essentially every workflow. And it's important. And again, if a beginner is listening and they're wanting to get into it, get with somebody who does have that and absorb everything that they are doing and use it as training wheels. And there's nothing, that's where some of the top people come from, is from other firms that are doing it, and steal every workflow that they're doing and utilize it, make it better, take it from different sources.
Did you say steal or did you say research?
Research, research it and compile it and compile the research to make it even better than what they had. And that's how people make things their own. It's just different sources.
Well, Josh, I have a thought on that, and I've done YouTube videos and I've been on other people's podcasts on this subject. For me, because I've been on both sides of it, and I've seen a lot of stuff. What are the 4 questions I would ask as an investor before I invested in a deal? Number 1, what happens if something happens to you?
Yeah.
If you don't have an answer for that, I don't need to ask any more questions. Number 2, have you done this before? Or have you done something like this that gives me the confidence? I mean, when I started, and when every syndicator started, we would have to answer that question. No, I've never done a syndication before, but I've been in the real estate business. I was educated. I was teaching CCIM. I owned my own properties. And so that was enough to get a certain group of people to invest with me in my first deal. So once I had your first deal, if they say, have you done this before? You say, hell yes. What? Fine. And then the third question is, are you going to have skin in the game? Are you, Josh, going to invest some money in it? And I was always concerned when I was doing it about the money part of the investment. But today, everyone is signing loans and there's carve-out provisions. So skin in the game is not only the money you invest, but the liability you're willing to take on in the financing arrangement. And then the last question an investor should ask is there a liquidity provision in your documents? What if I need to cash out? And so a well-written operating agreement has liquidity provisions for voluntary liquidity and involuntary liquidity. So those are the 4 questions you should ask. And I haven't even asked what type of property it is yet.
Yeah, I think that the skin in the game is huge because it's a huge question because not only are you willing to personally guarantee on the loan, but and if things go right, then of course you're on the line regardless if you got any money. That's going to be with you for the rest of your life. You're not only losing money, but now you're losing your credibility out there.
Right.
But you're willing to personally guarantee it. Plus, you're willing to execute on the business plan. So you've got sweat equity, and you're willing to make sure that everything's intact, and you're utilizing your structure that's in place as a business to insourcing the deal. So there's a lot of other ways, but the banks also look at your liquidity as an approval piece. How much liquidity does he have in a bank account? Well, if you're shelling out 800,000 here, $1.2 million here, 200,000 here, you're
That's right.
Eventually you run out of cash just because everyone wants money from you.
All my deals when I was raising money were all $100,000 minimum from the investors, and I never put in more than 50. They don't require it's the number that you put in, the dollar amount is a marketing question.
Yeah.
And the other side of the coin is I'd never syndicate anything that I wouldn't buy myself if I didn't have enough money. So I'm just like you. I don't have enough money to buy this myself. You don't have enough money, or even if you did, you want to diversify and not do this. So we'll all go in this together and make money side by side. That's an important part of the waterfall in a successful offering, making money side by side.
Yeah, and I think that there's definitely a balance on the deal split. So the GP, depending on who all's in the GP, and the LPs. If you're doing a 70-30, a 90-10, or a 50-50, there's reservations for, I think, each project. If you're doing a high level and you've got asset management, it's a massive deal. It's where you'd see like maybe a 90-10 because the numbers are so large, so extraordinary. If you're doing a value add on, say, a 50 unit or a 100 unit, and it requires a heavy lift, and there's a lot of effort, energy, and time going into it for it to be a success, that equity split needs to be balanced down to where, it's successful, but we're putting all the time in. It might be a 50-50. But if it's a success, there's a huge delta where everyone can win. And we're the team to do it because we've got a case study that proves that we've done it before and we can do it again. There's different balances there too on splits. Gene, can you tell us about the biggest syndication that you've ever been involved with?
Yes, interesting. The biggest one I've been involved with was a Regulation D offering. I'm going to use this term 506B, meaning that they knew everyone, no advertising. And they raised $165 million in 30 days. They had a network of family offices that they had pre-qualified, and what they were doing is it was going to be a blind pool, and they were going to buy medical surgical centers around the country. And they raised it in 30 days. And the smallest one, which is equally as interesting, was $350,000. And that's an interesting number because in a 506B, you can have 35 sophisticated investors. And so a teacher at an educational place in Maryland decided that he'd run a course, and everyone would contribute $10,000 to be a member of the LLC. And they would go out, and the course is, how do we do this? How do we find a property? And they went out and bought a house, and they renovated it, and they drafted the documents together. They studied the purchase and sale agreement. They studied the whole thing. And in 18 months, they sold the property, and they all made a profit. So you couldn't get in the class if you hadn't invested $10,000. I thought that was wonderful.
Yeah.
It's a positive deal. So anywhere between the most and the smallest, I've done the smallest.
That's probably the best way to pay for an education.
Well, I thought it was great. And of course, all the people were adults, and they They wanted to learn how to invest. They didn't necessarily want to learn how to be syndicators, but they wanted to learn how to invest. So that's what.
Think about it, they paid for their education, plus they made a profit at the end of it. It's wild.
You think they paid attention?
Yeah, no doubt.
That's good.
That's wild. Uh, and then there's also different structures, like a TIC structure, and then you've got a 1031 money. Can you touch a little bit on some of those other structures that might be coming to syndication?
Yes. Let's say you and I both owned a separate property. You owned one and I owned one. And collectively, we don't have enough money to buy this bigger property. But if we took our money and combined it, we could buy the bigger property. But the problem is we don't want to pay taxes. We don't want to, in getting the money out of our smaller property, we don't want it diminished by income taxes, by reporting capital gains. So we could buy this big property as tenants in common. Let's just say we have the same amount of money. So your money comes in and you get a 50% fractional interest in the property. My money comes in, I get a 50% fractional interest. All things being considered, that would qualify for a 1031 exchange because we started with a deed to real estate and we ended up with a deed to real estate. All we did is move our equity. And the 1031 rule says you can move your equity without it being diminished by having to report capital gains. Now, how does that work often in the syndication business? Your property that you own is owned in an LLC. And you came to me and said, boy, we need to buy this bigger property, but we don't have enough money by ourselves. My property is just my property. Okay, we'll go tenants in common. I'm going to get a deed and your LLC is going to get a deed. So I do every month I do one of those transactions where maybe even you found me and you know that I have enough money to do half of this big project, and then you form a new LLC and raise the money from investors to be a tenant in common owner in that property. And why it's so prevalent is anyone who bought anything from 2012 on and still owns it has a lot of gain. And so they don't want to diminish their net worth by reporting capital gains. So that's very, very, very practical and very popular.
Yeah.
But it's still a security. It's still a security. It's two entities going together, and someone is going to manage that, and they're doing it for a profit. So in my world, it's still a security.
Yeah, I agree. And there's sophisticated structures to really preserve, in my opinion, preserve equity from being deteriorated over the, just say being taxed on. So
Sure.
It's preserving it from property to property and carrying it on. And it's a sophisticated way of moving that. On the updates on security laws, what can we expect going into, we're in 2024, what kind of changes have you seen?
Great question. I'll talk about two things that came out in December. In addition to the SEC's report on the volume of business, every 4 years, the SEC has been told by Congress to look at the definition of accredited investor. And so a couple of years ago they did, and they changed the definition a little bit by adding spousal equivalents and telling people who have securities licenses that they're accredited, and telling groups if they have $5 million of assets, they're accredited. So actually, it's a long story since 1981 when Reg D started. Every change in the law has really been to promote capital formation, to make it easier for people to raise money, except for Dodd-Frank. And I need to mention this because what Dodd-Frank said is we're letting people be qualified as accredited investors, which means there's no protection from the government based on their equity in their house. They may not have anything else but equity in their house. and we're just letting them fly around and buy stuff. So in Dodd-Frank 2008, they took equity in your house away from the definition, the calculation of accredited investors. Okay, so when it started, it was $1 million net worth for an individual or family, or $200,000 annual income from a person filing an individual tax return, or $300,000 if it's a married couple filing. That's by definition you're accredited. Well, that was 1981 when $1 million was something in the statistics. The statistic that they said there was only about 2% of the families in the households in the United States that were accredited under that. Okay, so here we are now, 2023, the SEC comes up with its 4-year review and says, almost 20% of the households in the United States now are defined as accredited. That's way too many. So why don't we just go back to 1981 and apply inflation? And so if they did, the $1 million of net worth would be a little over 3 million. The 200 would be 6, and the 300 would be 9. Everything kind of triples. They said, what do you guys think about this? It's just a report. We have to do this. And what would you think if we did that? Secondly, and this is why I brought up Dodd-Frank, where they wanted to protect your home equity. They said, a lot of these people are accredited because of their retirement money. What if we just changed the definition and said it's your net worth, excluding your home equity and excluding your retirement funds? Should we let people risk their retirement funds? Well, that's interesting. So they put that out there. And I think their stated goal is to get the number of households that are accredited back into the 5 to 10% range. They did make a prediction of CPI going 10 years into the future. And if that was true, 32% of the households in the United States would be accredited if we didn't do anything. So somewhere this year, based on comments, they may very well come out with a proposal. And when they do a proposal, it's not anything other than just a proposal. It comes out and they give the public 90 days to comment. Then they think about it, and then they come out with a regulation. So I think I've heard this every year ever since the Jobs Act. I've heard this every year. Oh, they're going to change this, and they may very well change it, and there may be good reasons to. But that's one report. Now, the other report is the Office of Capital Formation inside of the SEC, who gives a report every year, and all they say is how tough it is for first-time syndicators, first-time businesses, women, minorities, how tough it is for people in South Dakota to raise money. And if you do anything with the accredited investor definition, you're going to make it harder and harder and harder. And small businesses, people with businesses with 500 employees or less, this is where they get all the money in that $2.7 trillion. And if you cut the number of accredited investors just in half, think about it. Today, you have 50 accredited investors investing with you and 35 sophisticated. Now, half of those accredited investors go away. You can't add them as sophisticated because that's still just 35.
Yeah.
So that's going to be harder to raise money. Maybe they'll increase the number of sophisticated investors allowed because there is protection for them if they change the accredited. But I think it's going to be difficult. But I've heard many, many discussions at SEC meetings I've been to on behalf of the broker-dealer community. And the broker-dealer community raises 90% of that 2.7 trillion. And all those licensed guys are making a living doing that. They don't want any changes at all. And they're a force. So what I would keep my ears to the ground and see what the SEC might want to present to Congress as some new rules in this year, and then maybe next year something will happen. But nothing now. It's just a report. There's been a report every year. Nothing's ever changed. But it is kind of silly to think that a person with $1 million today is as rich and smart as a person with $1 million back in 1981.
Yeah, no, I totally agree. A dollar definitely does not go as far as it does today as it did then, for sure.
Because all investments have, they've appreciated. There's inflation. You might own the same thing that you bought in 1981, and it's worth 3 times more. Great. But when they took the homeowner equity out of it, it cut the number of accredited investors. We lost 1/3 of our accredited households. So if you took the retirement funds, and then one of the positions was, let's eliminate retirement funds in the calculation of net worth, and then let's start adjusting for inflation now. Okay, so the million goes up by 4% this year, and whatever. That's fine.
I kind of agree with that, though. I mean, it will definitely. A lot of people will fall off the list of being defined as accredited, but at the same time, you're balanced. You're still keeping up with the times.
Yeah, well, what's that going to do to 506C? I mean, 506C has never been exciting. Of the 2.7 trillion that's raised in the private placement market, 2.4 trillion is raised in 506B from people you know. And last year, it was only like 169 billion was raised in advertising to accredited investors. It's just has not been important. That's because the broker dealers know all their clients. They don't need to advertise. They might advertise to get new financial planning clients. But once they get those clients and put them in their database, they know everything about them. So it's the pre-existing relation. I didn't want to get too deep into that, but that was the question.
That's great. And that goes into, I know we're running short on your time, but even crowdfunding, is there going to be any regulation, any more coming down the pipe on that front as well?
Yeah, there is some thought that, it went from 1 million to 5 million. There is some thought that we could take it to 10 million. And the thing about crowdfunding is that you can take non-accredited investors. So that might be good, but that's tough because you have to find a broker dealer who has a crowdfunding platform. And they don't like real estate because real estate, once again, doesn't have any liquidity. They get a commission for selling their clients, putting their clients in your deal. And then that's the only commission they get from that money in 6 or 7 years. So it's not attractive to them. We haven't found anyone to do real estate in a crowdfunding, regulation crowdfunding approach that we like. So, but we do use crowdfunding. My partner has helped people who make sake and make whiskey and do Airbnbs and stuff like that.
Got it. Very cool. Gene, if somebody wants to reach out to you and learn more about your process and say they've got a brand new deal, they're ready to syndicate it, what can they expect with the process? And then secondly, how can they get a hold of you?
Well, first of all, they should call me. I answer my own phone calls, and maybe people are listening to this, so I'll just say it's 949-855-8399. 949-855-8399. I'm in California. Just call me and I'll answer the phone and we'll talk. If we go forward, there's a fee agreement. There's a fee that has to be paid. There's a deal structure interview that I conduct with you. And then I start drafting the 3 documents. We also do all the securities filings. We have to file something with the SEC and something with every state in which you find an investor. So there's a bunch of stuff to do, and we do all that. And our fee agreement covers you all the way through the end of your offering and another 6 months. Because within the first 6 months, they're always, interesting things that come up that we might have to change or modify. So we're with you till things get settled.
Got it. That's great. Gene, we truly appreciate you coming on the show today. And again, I always like following you and keeping up with what's coming down the pipe from above. So appreciate your time. Certainly look forward to talking to you here soon, and appreciate it.
Thank you, Josh.
Thanks, Gene.
Bye.